Hello and welcome. My name is Greg Philbeck, and I will be guiding you through workshop review questions, in this case related to the topic of private markets. The particular case we're looking at here is what's known as the Barton case. And what we're looking at is basically a Barton real estate company that is offering closed-end funds. They work with high net worth individuals and also with family offices. We're going to be looking at the value add associated with multifamily real estate as a part of this case. We'll get a chance as a part of the questions that we'll be focusing on to better understand the characteristics associated with the fund, the ability to look at if there is a potential investment that would be economically feasible as a part of the offerings that are available to us, understanding a little bit about concerns as we set up, for example, issues related to debt service coverage ratios and leverage limits, how that can be impacted based on market conditions. And we will also look at execution risk that can occur as a part of the construction phase of a particular type of strategy in which we are doing some renovation. So we'll notice that as we open this case, a couple of things that should jump out at you. If you'll notice in the second to last line, that Barton is targeting these properties that can generate a 20% internal rate of return at the property level. And this is before, of course, we incorporate any sort of management fees or performance fees that would be charged to the fund. So let's go through and look at a potential investment opportunity for Barton. What we're looking at here is a 200-unit property, and the property has been partially renovated. 40% of the units were actually renovated within the past 5 years, but they've got plans to do renovations for the remaining 60% of the units. That's going to occur in a 3 to 5 year period going forward. Obviously, as these leases roll over, again, getting opportunities to make those renovations. Now, a couple of metrics that we have to be aware of. Obviously, there is leverage involved with respect to the property. The property would be leveraged with a loan that had an initial 55% loan to cost, with reserves available to draw to a maximum 65% loan to cost. We do have a loan covenant that we need to be aware of. There is a minimum of a 1.3 times debt service coverage ratio that we have to be able to maintain. So let's go through and start investigating the 4 questions associated with this vignette. The first question that we want to look at is to describe the investment characteristics of the Barton funds from an investor's perspective. Now, you can obviously continue to watch the broadcast as we go along, and we'll go straight to the answer. You can always stop the broadcast as I introduce each question, take a moment to try to answer it for yourself or think through the question, and then get started again by clicking play, and you can hear the response. So we are asked in this first question to describe the investment characteristics of the Barton funds from an investor's perspective. Well, a couple of things that we would look at from the perspective of the investor is that this is a closed-end fund. It has a finite lifespan, and generally that would be no greater than 10 years, but typically at least 5. There are some capital commitments that are taking place up front, and we're looking at a lock-up period and also some limited liquidity associated with the strategy. Now, we will note that because of the fact that we are looking at renovations, distributions to investors may include current income, and distributions may increase